Right, good afternoon, ladies. This is the third PowerPoint of CC12, which is Financial Markets and Monetary Policy, and this is specifically about central banks and how central banks help to implement monetary policy. This is covering specification 4.2.4.3, and the areas that we need to cover will follow on the next slide. So what you're going to need to know, the main functions of a central bank, well, we have talked about these briefly in previous PowerPoints on CC12, but that is something that you will definitely need to be aware of. That monetary policy involves the central bank taking action to influence interest rates, the supply of money and credit, and the exchange rate. So those three things are inextricably linked, both interest rates, the supply of money and credit, and also the effect that might have on the exchange rate for your currency. We'll also need to understand current objectives of monetary policy and how that's set by the government. And then also the role of the MPC, the Monetary Policy Committee of the Bank of England, and how that uses or tries to use bank rates, changes in bank rates to achieve the objectives for monetary policy, including in most instances this government target rate of inflation, which is also a shared target with the Bank of England. We need to look at some of the factors that are considered by the MPC when setting the bank rate, what sort of things are going to influence that, and also what are the planned changes going to hopefully achieve. And we'll also need to be able to understand how changes in the exchange rate affect aggregate demand and the various macroeconomic policies or macroeconomic policy objectives that we're trying to achieve. We also need to understand something about how this transmission mechanism works. So the monetary policy that's put in place, how does that then translate and transmit the changes in order to understand how the relationship between changes in interest rates and the exchange rate and also the inflation rate are put into place, and the reasons why those things hopefully work. We'll also need to look at how the Bank of England can influence the growth of the money supply, and again, dependent on the overall policy objective, that will depend on whether the Bank of England tries to increase the amount of money that's available, or actually decrease or reduce the demand for money, as we'll see. Other things that you need to be able to understand and demonstrate some sort of areas or areas of understanding include recent instruments of monetary policy such as quantitative easing, funding for lending, and also forward guidance, and we'll look at those independently shortly. And also the fact that we need to be able to understand how the MPC uses the change in bank rate to achieve objectives for monetary policy, including the government's target for inflation. So that's basically the first sort of, or the area that we need to cover in this part of the presentation. So a little bit of history, just to put it in some sort of context. And you may be quite surprised, and I know we've spoken about it once or twice before, that although the Bank of England has been around for an awful long time, it's only really been responsible for the operation of monetary policy in the UK since 1997. So not that long ago, really. We're only talking just over 30 years ago. To give it some context, the Bank of England has been around significantly longer than 1997. They were first established in 1694, and that was really in order to try to help the government to be able to borrow money. And the main functions of the Bank of England still are to issue currency, to manage government debt, and also to operate monetary policy on behalf of the government. In this instance, obviously, and one of the key things is that the Bank of England is seen as independent of government, although they are clearly working hand in hand to try to achieve certain objectives. And the last thing that we're responsible for, and again we've talked about it to some degree, is the regulation of the financial system. Well, that's clearly become much more important since the 2007-2008 financial crisis. Okay. And also ensuring financial stability, so making sure that banks stay viable, and also that making sure that the stability that the Bank of England can offer will hopefully then give confidence to both consumers and to firms to actually choose to expand and encourage economic growth. Okay, let's have a look at the role of the Bank of England in a little bit more detail then. Okay, so we mentioned that they've had responsibility for monetary policy since 1997, and basically there are two core purposes. The one is to maintain monetary stability, and that basically means stable prices and confidence in the currency and in the economy. And if we can maintain stable prices, and this is often defined by the government's inflation target, then the bank seeks to meet those objectives through decisions that are made by the Monetary Policy Committee, the MPC, and we'll talk a little bit more about who they are, who those people are, and how they go about their decision making. Okay, so if you haven't already watched the 7 short video clips, which we referred to in the previous PowerPoints, then it would be a good time to do that now, because effectively it gives you a much clearer idea of the different roles that the Bank of England has. They're quite entertaining. They're only a couple of minutes apiece, and that would definitely give you some decent context to sort of be able to understand the rest of the presentation that we're going to go through. And I've put a link there within the PowerPoint, and remember that I will also put these PowerPoints onto the shared area on Teams, so that if you want to go and take a look at those links, you can do so by just going on the slideshow presentation and clicking that link rather than have to key it in anywhere. But I'll put those onto Teams when we actually put the narrated PowerPoints on there too. So other roles of the central bank, in addition to the ones that we talked about, it's a banker to the government. So the Bank of England actually handles accounts for all government departments. In some cases, it will also make short-term advances to the government should the government need to finance any particular thing. It's also a bank to other banks. So in this instance, particularly given some of the issues that we've faced since 2007-2008, to some degree, the Bank of England, the central bank, will be responsible for making sure that some of the largest banks actually deposit sufficient money with them so that they can meet all of their commitments at the end of each day. So that's sort of another sort of regulation or check mechanism that the Bank of England is responsible for. They also can become what's known as the lender of the last resort. So if we get to a situation where a bank has short-term liquidity problems, what I mean by that is that it's got assets in its balance sheet, but they can't turn that into cash quickly enough in order to meet any commitments that they might have in terms of withdrawals and customers withdrawing their deposits for whatever reason. Then the central bank might actually make urgent payments that they may need to meet their commitments, and as a result, not to cause contagion or some sort of run on the bank of any description. It can also, in some cases, if that short-term liquidity problem seems to be developing into something more significant, the Bank of England, the central bank, has the option to bail out banks, and obviously in the financial crisis they did, or we did via taxpayers' money, to avoid the bank from collapsing, and then the danger of contagion and systemic failure of the banking system, which we got very close to back in 2007-2008. So there are significant roles for the central bank. And this applies in all countries, but obviously when we're talking about the UK, we're talking about the Bank of England, who is the central bank for us. A question that you could pose yourself or just have a think about is, should banks be bailed out or should they be allowed to fail? And there's some quite interesting stuff in your booklets on page 25, which talks specifically about some of those issues. Okay, talks a little bit more about the lender of the last resort, being the lender of the last resort, but also gives you some sort of ideas as to how you might structure your thought process, how you might evaluate whether banking bailouts would be a good thing or a bad thing, and that's something that you could give some consideration to when you're actually going through these slides and making sure that you've got a clear idea of what's included in the CC12 booklet. Okay, so that's a little bit of background in terms of the role and function, but now we're going to look more specifically at some demand side policies, and really from this point onwards we'll be looking at a number of demand side policies that the government and the Bank of England might choose to use to try to influence the way in which the economy might develop in the future. But in this instance we're looking specifically at monetary policy, so that's control of the money supply, and we can, by controlling demand for money, then that we can have some influence on the way in which an economy might be structured and might work. Okay, so there's some definitions included there. They are also in your booklets on page 26. So I'm not going to go through each one in detail, but they are all clear definitions explaining something about monetary policy through to interest rates and bank rates, what a policy objective is and what a policy instrument is, but also there's a mention there of quantitative easing, and that's something that we'll come back to and talk about in a bit more detail as we go through this presentation. So let's take a look at some of the tools, not so much the tools actually as the people who are responsible for trying to manage the economy, and certainly the monetary policy within the economy. We've talked about the fact that the Bank of England have these two core purposes, and one of the key ones obviously is monetary stability. So if we can get a stable monetary situation, that means we've got stable prices, and that's going to give confidence both to our currency, and exchange rates should actually then improve in our favour. But in this instance, obviously, the way in which the money supply is managed can have an influence both on stable prices and also on consumer and business confidence. Okay, so the Monetary Policy Committee are a group of people who actually come together each month and look specifically at the areas of monetary policy that they're going to decide on each. That most specifically is normally to do with interest rates or quantitative easing. So they meet at the Bank of England. The actual committee is chaired by the governor of the bank, and there are 9 members in total, 5 from the bank and 5 independent experts. So they have huge amounts of economic knowledge and economic experience, and will use that to assess on a monthly basis where they're going to take interest rates, what they might want to try and do with the economy in the future. There are a couple of links that actually explain a bit more about the Bank of England's monetary policy and what they get involved in and how they get involved in, but also there's some biogs of the people who are actually on the Monetary Policy Committee that you can take a look at too. I mentioned they met once a year. Once a month, and I'm sorry, that's not exactly right. It's 8 times a year, and basically they do that to decide on the bank rate and the amount of quantitative easing that may be required. Now, clearly, at the moment, given the situation that we've got with the pandemic and the fact that there is an awful lot of quantitative easing designed to try to help people through the furloughing process, and there's a significant investment, a huge amount of investment has gone into that, and that has been organised via the Bank of England through the purchasing of gilts and bonds, etc. And again, we'll look at that in a bit more detail. So the MPC is responsible for meeting the government's inflation target. That's basically that's their remit, is to by using different tools of monetary policy. It's about trying to meet the government's inflation target. The MPC has to publish its minutes, so whatever's gone on in their meetings, they have to publish. And if the inflation target is missed, the governor of the Bank of England must send an open letter to the Chancellor to inform him of that. A little question for you. I'm sure you're probably already aware of this, or if not, then go away and see if you can find out what you think the current bank base rate is, interest rate is, and also what the inflation rate is. Okay, so I'll give you a bit of time to go and search for that, or you might know already, but the actual answer to those questions are, and this is based on this month, January 2021, the base bank rate was just 0.1%, and the inflation rate was only 0.3%. So the actual target, as you may know, is 2%. So our inflation rate is significantly below the target rate. Now, as we've said before, being above the inflation rate is the inflation rate target of 2%. That's clearly a worry, but also inflation running at such a low rate could demonstrate that we might be going into some form of recession, and given what's going on in terms of the pandemic, that may well be the case. So sometimes that indicator needs to be borne in mind, and even when it would appear on the face of it, although that we're doing better than our target, well, if we go too low and we start to get deflation, where we've actually got a fall in prices, an actual fall in prices, then clearly that can be a dangerous signal that the government and the Bank of England need to think about in order to try to stimulate the economy, to try to actually encourage that inflation rate slightly higher. So the bank's remit and the inflation target, then. We've talked about this inflation target being 2%. Based on consumer price index inflation. Okay, now that target is announced each year in the budget. It has been 2%. The target has been 2% for a significant number of years. And to be fair, the Bank of England and the way in which they've managed interest rates and quantitative easing have managed to keep fairly close to that inflation target over the last sort of 5 to 10 years, I'd say. Now, obviously, the bank is independent, but in extreme circumstances, the government could actually instruct the bank to do certain things for a limited period. So at the end of the day, the government still has the remit to be able to say, right, no, we don't agree with you, the Bank of England, you must do what we require you to do. To be honest, they are likely to be very much in line with attempting to achieve things in the same way. So that would very rarely happen in the scenarios that we find at the moment. But that is an option should the government choose to invoke that. Okay. Now, the target's not necessarily the lowest possible rate of inflation, as we mentioned before, because, as we've said, inflation that's below that target of 2%, if we're running somewhere near to deflation, well, deflation generally means a fall in prices. And if we've got a fall in prices, that suggests that demand in the economy is on the wane, and that could then mean that that's a signal that we're going to go into some form of recession. And clearly, that's not something that anybody wants in the scenarios that we find ourselves in at the moment. So, if the target is missed by 1 percentage point or more on either side, the governor of the Bank of England has to write to the Chancellor explaining why the target's been missed and what they're going to do about getting it back to target. Now, one of the things that was very interesting, was fortunate enough to be at a presentation that Andrew Haldane, who was the chief economist at the Bank of England, gave a year or so ago. And he was saying that basically they've got so much information, so much data over years and years and years, and historical data that they can use to look at, right, okay, what happened in that situation? What did we do with interest rates? And how did that then affect, and how long did it take to affect the inflation rate? And clearly, using all that data and also the significant amount of simulation software, etc., that they can use, they're able to be fairly sure of their predictions, and as a result of that, more often than not, will be able to manage this process of controlling and managing inflation. The other thing to bear in mind is that clearly, because there is always a bit of a time lag between any policy setting and what might happen, there is going to be a time, or there will be times when we're not going to have inflation at exactly the point that we want it, i.e., 2% all the time. What the idea is that clearly the MPC is attempting to get inflation back to the target within a reasonable time, and we'll use the tools of monetary policy in order to try to achieve that. Okay, so a few questions here. So the first question, which is on page 27 in your booklet, talks a little bit about the bank's remit and the inflation target just above those questions, but then asks a few questions about, in this case, why is it desirable to have a central bank which is independent of government? That's the first question. Second question is, what aspects of monetary policy as described above are likely to make households and businesses feel confident in the operation of policy? And finally, the last question, why is inflation below target just as undesirable as above target? So I'd like you to have a think about those questions, have a go at answering them. There's some space in your booklets to be able to do that. And I'm going to just give you some time to do that now. So pause your presentation, have a go at those questions, and then when we reconvene, we'll run through what some of the responses could have been, okay? Okay. So welcome back. Let's take a look then at the first question. Why is it desirable to have a central bank which is independent of government? Well, there's a number of reasons really, I suppose, but the main one is that monetary policy is independent of political factors, okay? The Bank of England is able to run its monetary policy and can focus on the long-term interests of the economy rather than short-term political factors. So the whole principle of making the Bank of England, the central bank, independent of political factors, was to actually make sure that those people who were making the decisions were doing it based on the long-term interests of the economy, as opposed to getting votes that the government might be tempted to do as and when it comes to near to a general election. Second question then, aspects of monetary policy and how they might actually help to achieve confidence in the operation of the policy. Well, there are a few things, I suppose. The Bank of England is clearly accountable to the government and to the public. Why? Because the governor has the right to a public letter if inflation is more than 1% off the 2% inflation target. And in fact, with the forward guidance principle that the Bank of England have been applying over the last few years since Mark Carney was involved, there is an argument to say that they're using the opportunity of communicating via the media to actually forewarn people and give some sort of guidance as to what the plan will be over a reasonably long period of time, and hopefully that will give more consumer and business confidence as a result. The other thing is that the Bank of England has to publish minutes of all of their meetings, so the public can see how each member of the MPC voted and can see the clear reasons and rationale behind what the Bank of England are up to. In addition to that, it also publishes a quarterly monetary policy report, and that again explains the Bank of England's view and also its forecast for inflation. So again, rather than just trying to second guess themselves or the economy, businesses and individuals can actually get access to information about how the Bank of England is thinking and where that might take them in the future in terms of interest rates or trying to stimulate growth or whatever that might be, depending on what the overall policy objective is. If we then look at the third question, why is inflation below target just as undesirable as above? Well, we've sort of referred to that already, but if we've got inflation that's below the target of 2%, that could mean that we're starting to get lower economic growth. And obviously, if we have two quarters of negative economic growth, then we're into a recession. And clearly, recession has all sorts of issues in terms of firms deciding to reduce output. And then as a result of that, maybe actually reducing the number of employees, and so unemployment is going to go higher. And as a result of that, thinking about chains of reasoning and linked thought processes, then clearly that could be a very good reason why, if we start to get inflation running at a very low level, significantly below 2%, that might be an indicator that economic growth is about to stall, and obviously that can be just as dangerous as having a higher inflation rate. As we mentioned before, there could be a risk if we've got this low inflation rate. That could mean that there could be a risk of deflation where prices start to fall, and that obviously is then going to be being driven by the level of demand in the economy, and that clearly can be a dangerous place for any economy to be in. So if we then take a look at the what we just talked about, and just over the next couple of slides, and again, I'm not going to read these word for word, but we've just developed the responses to those questions a wee bit further. So the fact is that we've got a number of different factors that we need to bear in mind. In this instance, we're talking about central banks. If we've got this independence from political considerations, then it should mean that they are able to really target low inflation and focus specifically on that and nothing else in terms of their policy setting as far as monetary policy is concerned. Again, that independence should give consumers and businesses more confidence, and hopefully, as we talked about before, animal spirits and confidence are really important when it comes to consumer confidence and consumer spending, but also firms' investment in new output or improving output, and also possibly employing more staff. And clearly that confidence is clearly going to have a significant effect on aggregate demand. And there's the example of Japan, which has had very, very low rates of inflation over a significant number of years. And one of the issues was and is that as those low prices, or those prices that were essentially falling, that effectively has meant that output has fallen, and as a result, unemployment has risen. And again, you can use that as an example to quote in any of your answers in the future. Okay, let's look more specifically now then at interest rates and how they might how in this instance monetary policy might work. So this graphic actually demonstrates just how you might be quite surprised when you look at this, and I know we talked about this briefly before, but just to give you an idea of where Bank of England interest rates have been since 1694 when they were first introduced, right the way through to 2009, and in fact we go on slightly further than that. Obviously we're about another 10 years on from that, but you can see that as a general rule, around about the 1700s we were talking about anywhere between 6 and 3%, and then it sort of seemed to average out at around about 5% for a significant period of time. And then, as you can see, it went a bit staccato, went up to 10%, around about 10% on a couple of occasions in the mid 1800s, and then seemed to stabilise a wee bit over 1900s, and then clearly when we've had major shocks, major external shocks of any description, so obviously the World War was a significant major external shock, as was the Second World War. We got the Wall Street crash of 1929, and then each of these crashes, or each of these instances where we have significant events, in order to try to stimulate economic growth, interest rates have fallen significantly. But then when we had Black Wednesday around about 1992, when we had all sorts of issues in terms of trying to manage our exchange rate and the level of exchange rate that we were trying to achieve in order to go into at the time, the European currency, the ERM, you can see that at one stage interest rates were up at 17%. 17%. And when you consider now where we are now, our current the current interest rate, the current base rate is 0.1%. Okay, so although it was mentioned that it's 0.5% at 2008, 2009, our current rate at the moment is 0.1%. So historically low interest rates. And the whole reason for those historically low interest rates is to try to stimulate spending and growth. So Let's take a look at how monetary policy works then. So on page 28, it tells you a little bit about how that might work, and essentially it's about influencing aggregate demand. But we've got two options basically. We can actually increase the bank rates, so increase interest rates, and if we do that, we're essentially trying to deflate or contract the money supply. And the overall aim in that instance, if we were going to try and increase bank interest rates, would be to reduce aggregate demand. That might be due to the fact that inflation is too high, above our 2% target, and as a result of that, we want to try and reduce that. Okay, so that's the one option. We have the other option of reducing the bank rate. Okay, and obviously this is designed to try to reflate the economy, or it's sometimes known as expansionary monetary policy, and the whole principle is about aiming to increase aggregate demand, okay, and stimulate hopefully some economic growth. So those are the two options when we come to look at interest rates specifically. So let's just take a look then at this in a little bit more detail then. So if we actually decided that we wanted to have a higher base rate, higher interest rate, what would the effect of be on consumer spending? Given that 60% of all aggregate demand is based on consumer spending, it's an important one to understand how that might affect things. Okay, so thinking about a higher base rate, well, mortgage repayments would be higher, borrowing would become more expensive, but saving would become more attractive. Okay, and as a result of that, those three things would essentially cause lower consumer spending. Okay, so what impact, or what does the impact on consumer spending depend on then? Okay, so we've said that a higher base rate could actually affect all those things, but I want you to have a little think about what impact what would be the level of impact on consumer spending, and what would that depend on? So there is some space in your booklets to be able to just scribble down a few ideas on that, and then we'll take a look at how you might be able to evaluate that process very shortly. Okay, so let's have a look at the evaluation of higher interest rates on consumers then, okay? Well, clearly it's going to affect people in different ways, and the effect of higher interest rates isn't going to affect every consumer in an equal way. Now, clearly anybody that's got a high mortgage, got large mortgages, and often those tend to be the first-time buyers, so people who have just got on the property ladder, they are going to be disproportionately affected by higher interest rates, because if we think about this principle, okay, if we're trying to reduce inflation, that might mean that interest rates need to rise to a level that could cause some real hardship, because effectively, if your interest rate goes up on your mortgage, that means you're going to have significantly less money to spend on other things, okay? So in addition to that, on the flip side of that, if you've got savings and you get interest rates that are on the rise, then that clearly can be something that is going to allow you to become better off by saving money rather than spending it. Okay, and obviously, dependent on, if we're assuming that everybody will be affected by higher interest rates in the same way, well, clearly that's not going to be the case, and as a result of that, that assumption suggests that at times that the monetary policy is a less effective macroeconomic tool than sometimes it's given credit for. There's always going to be a time lag. We mentioned this before. A lot of the policy instruments that a government might, or the Bank of England in this case, might choose to use, is going to take some time to implement. Not just to implement, but more importantly, to have an effect. So if you think about this as a principle where you're actually thinking about borrowing some money and your investment project is halfway through, you're likely to finish that off in a certain situation, okay? However, if you get higher interest rates, that might discourage you from starting that project until the next year, or until interest rates have calmed down to some degree. Clearly, again, as with any of these policies, there is always going to be other variables you need to bear in mind. So clearly, in some cases, interest rates can be used, but they may not necessarily have a large impact on reducing growth of consumer spending. Okay, so house prices, as an example, could continue to rise very quickly for a while, and in some cases, people might think, well, actually, there's no real incentive. I'm going to carry on spending in spite of the increase in interest rates, dependent on where they are on, in their decision-making process on choosing to buy a car or something similar. Okay. Need to also bear in mind the real interest rate. Okay, so we've got two things to bear in mind. Okay, one is that obviously if we've got nominal interest rates, which don't take into account inflation, one could argue that if we look at what the real interest rate is, that's basically the nominal interest rate, take away inflation. Okay, now if inflation is significant, then one could argue that in that case that we may, even with an increase in interest rate, may still be better off in real terms, because effectively a cut in interest rates, or sorry, in this case, if we've got inflation at a high rate, then interest rates rising might still actually be a cut in the real cost, because interest rate is not interest rate, sorry, inflation rates are actually minimising the effect of this change in the interest rate. Okay, so other things to bear in mind, the interest rates aren't necessarily always going to be passed on to consumers. The changes, banks might decide to reduce their profit margins in order to keep their commercial rates unchanged. And in some instances as well, obviously one could think that if people have got so used to getting low interest rates, then there's an argument to say that that maybe lots of people have extended their borrowing as a result of that. And when there is a change or a shock, that could obviously be a bit of an issue, because people have been so used to and thinking about how long it's really not been since 2007, 2008. We've had interest rates at a very, very low rate, which is the best part of coming up for 11, 12, 13 years now. So we've had interest rates at a historically low rate, and people have got used to not paying a great deal of interest rate. Clearly, a big change could be a significant shock to the economic system. Okay, let's have a look at this on the basis of the effect on investment then of a higher base rate. Okay, so if we're talking about investment by businesses or individuals, it's obviously clearly going to be more costly to borrow. Probably going to mean that fewer projects will be worthwhile at this higher cost, and as a result of that, you're going to tend to get less investment. Okay, so the higher base rate, higher interest rate, making it more expensive to borrow money, is likely to cause less investment. But obviously, the effect on investment is going to depend on a number of things too. And in the same way as we just done, we'll look at how we can evaluate the effect that might have on investment. And let's take a look at that together now. So again, we've got the same principle. We've got time lags. A business might have chosen to start an investment project, and even with a rise in interest rates, is unlikely to change its decision unless it's a significant change. Okay, so again, bearing in mind that might then mean that the firm will carry on, or fundamentally, it might actually then make them think twice about future investment projects. So again, the interest rates changing will have a time lag effect to bear in mind. There are also going to be other factors. We mentioned that in 2008, 2009, interest rates were cut from 5% to 0.5%. But because of the significantly deep recession that people had been going through, there was, to some degree, because banks got a bit more twitchy about who they were going to lend to, that meant that they were less willing to lend money. But also, the lack of confidence in the business, in the economy, meant that even though in some instances it was significantly cheaper to borrow money, people still weren't doing so because they just wanted to. They weren't sure. They weren't particularly certain about the economic outcomes that were around the corner. And fixed interest rate loans clearly would also have an effect. It would mean that in some cases, if you've got a fixed interest rate on your borrowing, a change in interest rates, a rise or a fall in interest rates, will have very little effect on their borrowing costs, on the current borrowing costs. Okay, so let's have a look at page 29 now then in your booklets, and there's a paragraph on interest rates and exchange rates, which I'd like you to have a read of, and also there is a fill in the words type exercise there that I'd like you to take a look at. Okay, so at the top of page 29 there's a paragraph, and then I'd like you to have a go at trying to fill in the gaps, so to speak. Okay, so the next thing then is to look at the way in which interest rates and exchange rates are inextricably linked. Okay, so if we take a situation in this scenario, then where we've got how is the interest rate, or how is the value of the currency linked to interest rates? Okay, well, let's think about this then. Okay, if we've got a higher level of interest, we're going to find it's going to be more attractive to save sterling in UK banks. Okay, that in itself, the fact that we've got high interest rates, we're going to attract the hot money people, investors that have got a few bob sat in their bank account. They might just be shipping that from one country to another, dependent on the level of interest rate that they're likely to receive from those different places around the world. Okay, now if that's the situation, we're going to get a higher demand for pound sterling. Okay, now that the very fact that people are willing to invest in UK banks, they will then have to swap some of their currency for sterling in order to gain that higher interest rate. That's going to then mean we're going to get a rise in the value of sterling. But that, obviously, whilst that's a good thing because it's demonstrating that we've got a strong economy, one of the issues around this rise in the value of sterling means that it makes exports more expensive. Okay, and if exports become more expensive, there's going to be a fall in demand for exports, and as a result of that, you're going to find that exports will fall. Okay, so following that chain of reasoning, we also need to then think about how we're going to evaluate that then. Okay, and let's just take a look at that again together. So, looking at the impact of exchange rates or interest rates, a change in interest rates on exchange rates of currency. Number of things to bear in mind when we're talking about exchange rates. That is determined by a number of factors. One could be interest rates, as we mentioned. Another could be confidence. Another could be the current account on the balance of payments, where we are with economic growth, and also relative inflation rates. So you've got lots of things that might affect the rate of exchange rate of a currency. Okay. Now, in this instance, where we're talking about interest rates, one could argue that if businesses become relatively more competitive, i.e. more internationally competitive, so maybe we reduce our production costs, or we improve innovation, or we improve the product quality, whatever it might be, that could mean that we're going to get a greater demand for UK goods. Okay, and if we get a greater demand for UK goods, that would cause an appreciation in the value of the pound. So we get an increase in the value of the pound because more people would want to import our goods. Okay, and in order to do that, they would need to change their currency. Let's say that's Germany. They would need to, so a German importer would need to take some of his or her euros, convert that into sterling in order for them to be able to import some of our exported goods. Okay. However, other things to bear in mind, other things that could have an effect, where we've got uncertainty in the marketplace, and if we think about where the UK economy has been and what with Brexit uncertainty, there's an argument then in that situation, if investors are a bit jittery and they're not too sure, they are likely to sell any pounds, any sterling, and that's going to lead to a fall in the value of the pound. So you can see that there is a definite link between interest rates and exchange rates, and it's important to try to understand that whole principle. So let's take a look then at the overall effect on aggregate demand of raising interest rates. So I'd like you to have a go at thinking about, if we get a rise in interest rates, how is that going to affect aggregate demand? So you've got in your booklet on the bottom of page 29, you've actually got a graph that you can fill in. So I'll give you some time to have a go at that. I suggest you do it in pencil in the first instance, and then we can take a look and see if I don't think you'll find this one too difficult, to be honest. But should you need to change it, then obviously you can do. Okay, so in this instance, we want to show the overall effect on aggregate demand of raising interest rates. So in this instance, then, we would get a situation where aggregate demand, if we actually increase interest rates, is likely to fall from AD to AD1. And you can see that in that situation, that is then going to cause real GDP to fall and also the price level to fall. Okay, so interest rates in this instance have had their desired effect. By raising interest rates, we've reduced aggregate demand, and as a result of that, we dampen demand and also reduce the overall price at the equilibrium point of where we change from AD to AD1. Okay, so if that's obviously essentially, if we're talking about raising interest rates, we're effectively attempting to deflate the economy. We're attempting to contract the economy because we're concerned about the level of inflation. If we then look at expansionary monetary policy, then that's essentially the opposite, and that's where we're trying to stimulate aggregate demand if we believe that our inflation is expected to move below the target. That would usually mean that that would involve a cut in the bank rate. Okay, and the reasons for that is that we want to try to stimulate more growth. So, if this were the situation, and let's assume we've got to explain how this would lead to a rise in AD, if we're talking about reducing interest rates. So all of the interest rates in the economy would fall. Savings will become less attractive compared to spending. Borrowing will become cheaper. So the demand for consumer goods or consumer durables will rise. Mortgage interest rate will fall, leading to a rise in the demand for houses and also a rise in house prices. Then higher house prices will cause a positive wealth effect, where people will feel, well, they've got an asset that's worth more money, and so they're more likely to spend more. This demand for business borrowing and investment will also rise, and the external value or the exchange rate of the pound will actually fall in this instance. The reason being that if we have a cut in the interest rate, that's going to mean that we're going to have less people willing to invest or put their spare money into savings in the UK. And the level of exports in this scenario would rise, okay, where effectively that cut in the interest rate would mean that our costs of production would be significantly less. Okay, so let's take a look then at this next scenario then, okay, where we're looking at expansionary monetary policy and aggregate demand and how that affects things, okay? So we've looked at how contractionary policy, monetary policy might work, but if we're talking about expansionary policy, essentially what would happen here would be that we would move from aggregate demand, would move out to the right, would be a shift to AD1, and as you can see there, effectively that is going to cause an increase in output and also an increase in price. So that should, by reducing interest rates, because it then makes it more likely for people to borrow money or to use money or to spend money, that hopefully is going to then stimulate aggregate demand because of that. Okay, and in this instance, consumption would rise because there is more money available in the economy. And as we mentioned before, 60% of the total aggregate demand is down to consumer and consumption. And in this instance, because we've got this increase in output, that would also mean that investment in firms is likely to rise because, number one, it will be cheaper, and number two, there is more demand for goods and services. So businesses are more likely to invest in further capacity and further output. Okay, so we're going to just move on and just take a look at the interest rate transmission mechanism, and then I think we'll stop and then look at quantitative easing and a couple of other things in the next presentation. Okay, so in this situation, And again, you've got this in your booklets on page 31. This principle of the official base rate, which is decided by the Bank of England, that obviously has, if the Bank of England decide to change that official base rate, that's going to have a knock-on effect on market rates, on asset prices, on expectations and confidence, and also the exchange rate. So significant one thing is then going to transmit to changes in market rates, asset prices, etc., etc. And as a result of that, that's then going to affect both domestic demand, consumption, investment, and government spending. Total demand, that obviously is then going to also be affected by net external demand, the difference between exports and imports, and that will essentially cause some sort of higher levels of demand, is going to cause some sort of domestic inflationary pressure. Okay, and import prices clearly, again, dependent on where exchange rates go as a result of the change. You can see that this transmission mechanism has a significant effect. So one change here by the Bank of England will have a knock-on effect in a number of these different areas. Okay, and it's reliant on those things to work through in order for monetary policy to be effective. So let's take a look at the two things to bear in mind. One is obviously we talked about this time lag principle between interest rate changes and them having an effect. But also, I just want you to take a look at this last page, and we'll, like I said, we'll stop and move on and finish off the rest of CC12 in the next presentation. But one of the things that the Bank of England has been doing over a period of time is looking at the inflation report, okay, and created this fan chart essentially where we're talking about the position where inflation has been for a period of time, all the way up to around about 2000 and just early 2020. Well, what this fan report suggests is where the Bank of England at the time or the Monetary Policy Report felt that inflation might go in the future. And the stronger colour, the brighter colour, as you can see, is the place that they think it's most likely to go. Now, obviously, one could argue that is around about the 2% inflation rate that they're aiming, and that's the target that they've been set. But clearly, this was done back in early 2020, January 2020, or nearly a year ago, and may not necessarily have considered what's happened to the world in the last year or so. So that's something to bear in mind. Okay, now clearly, where you've been given data of this nature, one could say that in this case, this current forecast would suggest that from 2020 to 2022, the likelihood is that we're going to be running at anywhere between 1.5 and 2.5 straight 3% inflation. Okay, if we take the darker red as the most likely outcome. Now, that's the one that's most likely to have the highest probability. So there is an argument to say that inflation would rise to just over 2% in the next few years. And if the policy that has been set, which was to try to encourage growth and to try and encourage a small amount of inflation, that would clearly suggest that policy would be being successful. However, what sort of effect do you think that the pandemic that we're facing may have on inflation? We've already mentioned that the current rate of inflation, rather than the target, is 0.3%, and it doesn't take a genius to think, well, actually, it wouldn't take much. With a little bit less inflation, we could be into deflation, which obviously could mean that we're into recession. So that's something to bear in mind. Okay. So thank you for listening. I hopefully that we've covered quite a lot of ground in that, but obviously you can take a look at the narrated PowerPoint as many times as you like, and obviously use the booklet to work your way through that. But that sort of gets us to the end of page 31, and in the next presentation we'll take a look at quite specifically at quantitative easing. Okay, so thanks for listening, and hope you found that useful.